William Lee is the chief economist at the Milken Institute, back with us here. Bill, great to see you again. As we've got now updates on this China-U.S. front, the phase one situation, the volatility of the headlines is still there. But what about the volatility of the economy? I mean, do we expect quick snapbacks or changes based on all these developments?
Not at all, and I hope we don't get them, because that's the worst kind of reaction to get, is to have sudden knee-jerk reactions. Let's remember, in the world of trade talks and diplomacy in general, trade talks with the WTO used to take decades. Remember, the latest ruling we had about Airbus was a ruling that has been put in place 11 years, from talks that took place 11 years ago. So when we talk about 13 meetings with the Chinese, that's barely the beginning of the process of integrating the Chinese economy and the U.S. economy together in the world economy. And so let's be patient and look at trade talks in the perspective of other trade talks. And also, let's keep in mind the achievements of negotiation is the fact that we keep talking. Once we stop talking, that's when things totally break down.
This is an important point, because a lot of people were scratching their heads, I think, going, hey, why'd the market rally so much on what seems to be words rather than paper? But as many on the show point out here, at least the words were nicer words, right? Markets are relative. Our economies, though, and the potential for businesses to make different decisions than they have for the past year, is that going to change? What are we seeing in the evidence?
You're absolutely right. It's the first derivative got corrected. After the spring, when talks broke off, we saw tensions start to rise. We saw a lot of uncertainty start to come into play, and people starting to get worried about recession, because it looks like trade was going to go down the toilet. And I think what we have to remember is that the achievements of the words that we come from phase one is that we have progress toward agricultural purchases, industrial purchases, a framework for intellectual property protection, and more importantly, some beginnings of a mechanism for contract enforcement. That's the real kicker that was killing the deal back in May, was that the markets and the negotiators themselves felt there wasn't a mechanism being put in place that both sides could agree with, where disputes could be resolved. And that's really the key to most of these trade talks, is how do you resolve disputes. And that's what's I think the beginnings of that are foreshadowed in this phase one.
Now we see, obviously, as this kind of truce for the moment, takes hold through the markets, we see a little bit more risk on. Is that going to last, and is the overall kind of hope for this kind of reflationary trade that kind of peeked its head out Thursday, Friday, right? Bonds continued selling off. We had some strength in industrials and banks. Bill, what's the sort of backup we need from the economy to justify these types of leadership?
We need to see some signs that business fixed investment starts to pick up again, that CFOs and CEOs are confident enough to start making expenditures for capital equipment, for technology and improving technological progress, because that's really the core that we need to get the economy rolling again and boost productivity. The one thing that I worry about most is that the commentary that we've heard continues to resonate with people and say, oh, it's just a bunch of soybeans. There's nothing done in this deal. We have no progress at all. That will truly throw victory into the jaws of defeat, because what these ag purchases and industrial good purchases, these first steps, they're like, remember when Nixon opened China? These ag purchases are like the same role as ping pong. Ping pong was the mechanism by which we started to build relationships with the Chinese. These ag purchases are China's way of building relations with us, the farmers, and showing that they do need the United States, even in these basic terms. And then the United States is coming back to them and saying, we need your marketplace as well. Where is Boeing going to be without China purchases of their aircraft? So these are the initial steps that are going to take us toward that ultimate set of deals where we have intellectual property protection, we have reduction of state subsidies, we have freeing up of markets in China. These things will take time, and I think they should be measured in decade time, not monthly time.
This is really important, Bill, because I think, again, one of the core questions of this market, when you and I have discussed, it's really tough to figure out, is how much of the economic slowness that we've had this past year that just hit shores in the U.S. in the manufacturing and actually the services ISM, which missed the lowest in 3 years too, the last time we had the reading. Showing up now on our shores, how much is tariffs, how much is a natural cyclical slowdown that started to build really before this heated up? Do we get closer to an answer as we see how CEOs and the capex that you described responds over the next 6 months?
That's really key. If the orders for durable goods don't start to pick up, and we don't see a commentary on the part of, in fact, in these earnings calls, a resolution saying, I really believe the world economy is going to stay in place. I really believe that trade can pick up. I really believe that Europe will go into the doldrums. If those are European problems that have all been long-standing structural problems. So Europe is on their own, but they can be helped by a boost to Chinese import demand, and the U.S. could be helped by that. If that talk starts to pick up, then I'm going to be very confident that things are going to be fine. Talk of recession really is the fear that the world will collapse, and therefore I'll be nuts to make capex expenditures now. If that kind of thinking takes place, then that truly is the mind killer and the economy killer that will put markets into a tank.
In August, last time we spoke, I believe, Bill, we talked about the yield curve to kind of connect this back to the bond market, about the possibility that maybe this wasn't as pure of a signal in the past, given speculation about what central banks were going to do. Since then, our 10-year versus the 90-day has actually uninverted itself, so we're still kind of on the precipice there. But Bill, how does the tariff situation in your mind relate to the Fed situation? Because we know the president's still going to be pushing for the cuts, but the probability now has dropped a little bit. I mean, is the Fed, how does that force compare to the force of tariffs on the economy?
Well, I worry a lot about the Fed situation because, as we spoke before, there's no CEO out there that says, "My God, it's too expensive to do capex right now."
Right.
The cost of capital is incredibly low. What they're not confident in is that the Fed is there to backstop growth. That if things really go down the toilet, are they going to be there to act quickly and act in force? And right now, Chair Powell doesn't show that he has the command of the FOMC. The dissent that used to be internal has gone public. You have a lot of talk on the FOMC that we don't need cuts, we don't need to do anything, things are fine. That's the kind of talk that causes people to worry that the Fed won't be there. And so Chair Powell has really got to get his act together and really show the markets that he, like previous strong chairs before, is able to forge a consensus among the FOMC dissenters. And that he hasn't shown yet. And so the only kind of statements that Chair Powell can do at the press conference is a compromise statement that says, we'll do what's appropriate, and if things do tank, we'll act appropriately. Well, that doesn't spur a lot of confidence among market participants, and certainly not among CEOs. So that uncertainty from the Fed, I think, is one source of where the tariff uncertainty is being compounded without that strong policy offset that we would normally have if we had a strong chair.
Can CEOs feel confident, Bill, if that consensus is a little bit more hawkish than what the market has expected in the past? What if Powell gets the crew together and says, look, guys, let's put out a message that is more dependent on data, that points out the yield curve's uninverted, that maybe we don't need to rush to answer the market's calls for cuts every time it happens? Is that a possibility, or is that still a risk point?
A framework for doing that isn't in place at the Fed because they can insist that their mode of operation is that we're data dependent. We're going to look at the latest piece of data and decide from there. That means you're flying by the seat of your pants, and that is not confidence building. If they were to say, our goal is to make sure that growth is there, and let's coordinate with other central banks to ensure a coordinated approach to monetary policy and get fiscal authorities to act. If we can get all of the central banks in the world to start pressuring fiscal authorities to put in place the requisite fiscal policy, like especially in Germany, then I think markets will be very confident that things are in place to backstop growth. But without that kind of coordinated call on the part of the Fed and central banks for the fiscal authorities to get their act together, I don't think we're going to get the kind of action we need.
Bill, one more before I let you go. I know you do a lot of work and pay very close attention to the signs out of China, not just on the tariff front, but overall the potential for the economy to respond to some of their stimulative efforts. What are we seeing right now? What are we seeing in terms of the ex-U.S. story that was used as basically the reason for why our bonds got dragged so low in yield for so long? It was the rest of the world. How does the rest of the world look to you right now, Bill?
I think emerging market investors still look at the U.S. as the brightest place to put their money, and that's why capital inflows are still so strong, which is why you see the yield curve still so flat. I mean, if in fact people were starting to say, oh, it's time to just blow our investments in emerging markets, you would see this rush out of the U.S., you would see the selling of treasuries, and you would see the yield curve start to steepen again. You don't see that. China right now is in between a rock and a hard place. They're trying to get the domestic services and private sector up by a lot of tax cuts, but a lot of it's just like in the U.S. economy, the uncertainty is causing Chinese consumers to save those tax cuts instead of spending them, and so their success is really not so good, and the fact that they still have the hardliners in Beijing are still having to support the state-owned enterprises who are very inefficient, and those are the state-owned enterprises that are giving China the drag on growth that it doesn't need right now. It really needs to spur that private sector where if they were to really succeed in doing that and toning down the state-owned sectors, we could start to see growth go to 6.5%, 7% easily in China. But again, Xi Jinping has got a political problem too, because a lot of those hardliners, a lot of his political backing are the owners of the state-owned enterprises. So he's got a political tight wire, high wire act to do as well.
Bill, I got one more for you while you're here. We're going to keep you around for a sec because news is breaking right now. If we check out the pound intraday, guys, 6B is on the run, Bill Lee, because headlines are that the EU and the UK are closing in on a draft Brexit deal. So if you don't mind, I'm curious your response. We've got bonds selling off a little bit. The British pound's at 128, adding on to the surge it's had. How much potential does this have to provide relief to some of the things we were just describing? Yield curve, expectations for stability.
Exactly. In fact, the Brexit uncertainty is what has also added to that trade doldrums of people not wanting to do business, because you don't know what markets are really going to be there and how you're going to interact with those markets. If Brexit really can be resolved, whether it's a no-deal Brexit or a deal Brexit, who the hell cares? Just get Brexit done. And once it's some sign that that's over with, I think you're going to see a lot of recovery in global trade.
As we see the pound take a little bit of air out of the dollar this past couple weeks, it's really been the main catalyst for some dollar softness. Does that have the ripple effect potential, Bill, on the rest of the world?
Well, again, you have to convince global investors that the UK is the place to start looking into to throw their global investment dollars and investment currencies. I don't think people are convinced yet that Brexit is in place so that the British economy can continue to enact policies that will spur growth. And so I think it's a good sign. The sign that the pound is strengthening is good, but emerging market currencies are the key things to look at. And I don't think the dollar has weakened relative to a lot of those. A lot of the emerging market investors still want to put their money in the U.S.
Bill Lee, awesome conversation as always. Glad to have you here on a little breaking news too. Bill Lee is the chief economist at the Milken Institute. Always a pleasure.